Assalamualaikum warahmatullahi wabarakatuh. Disclaimer: I am Zayd Haji, a regular student of finance, not an economist, policymaker, or legal expert. The views expressed in this podcast are purely academic and based on publicly available information. They are intended to promote discussion and critical thinking, not to criticize, challenge, or oppose any government, policy, or action. Nothing mentioned here should be taken as investment advice, policy recommendation, or legal opinion. Please treat this purely as a student's perspective for educational purposes. Nation on lease, the interest trap that's holding India hostage. Welcome to the IFR podcast channel, the voice of ethical finance for a world in search of moral clarity. I'm your host, Zayd Iqbal Haji, author, researcher, and founder of 3 impact-driven platforms: IFR, Islamic Finance Research; ISR, Islamic Studies Research; and IGC, Islamic Guidance Council. These institutions were not built for branding, they were born from a need to bridge revelation and real-world systems, to revive amana in leadership, and to reimagine finance through the lens of faith. Through my books, Investing in Value Stocks, Investing in the Stock Market, Investing in Mutual Funds, and Business and Money for Life, I've sought to demystify money with actionable knowledge. And through Unlock Your Mind and Self-Respect and Self-Esteem, I've explored the emotional undercurrent of financial decisions and spiritual dignity. In this episode of our ongoing series, Zayd's Rules Ethical Finance for a Global Audience, we turn our gaze toward a reality often hidden in plain sight. Nation on lease, this isn't a metaphor. It's a diagnosis of the modern world where sovereignty is sold, policy is pawned, and nations, once built on principles, now run on payments. From colonial residue to neo-colonial debt traps, we dissect how economies are mortgaged and how financial dependency is institutionalized. This episode is not just about what's broken, it's about what needs rebuilding. Let's begin. Nation on Lease, where we dig deep beneath the glitter of economic growth and uncover the uncomfortable truths about how modern finance really works. Today's episode is not just a conversation, it's a wake-up call. Because behind all the GDP celebrations, investment headlines, and forex numbers lies a silent crisis. One that's pushing India into a cycle of endless borrowing, interest payments, and economic dependence. India on credit, the nation's ledger unlocked. Let's pause the noise of headlines for a moment and ask a deeper question. How much debt is the government of India actually carrying? Not the kind of debt you whisper about at a tea stall, but the true scale of what the union is obliged to repay year after year with interest, diplomacy, and often compromise. As on March 31st, 2026, the total internal and external liabilities of the Indian government are projected to reach an astounding 196.78 lakh crore. To put that in perspective, that's nearly 200 trillion rupees. A number so large, it could fund hundreds of social schemes, pay for countless infrastructure projects, or even underwrite several years of national budget if it weren't already owed. Now compare this to the previous year, March 31st, 2025, where the government's total debt was 181.74 lakh crore. In just 1 year, the burden grows by over 15 lakh crore. That's not just inflation, it's compounding commitments. Let's break that number down further because this is not just academic jargon, this is the financial DNA of the country. Internal debt and other liabilities, which include money the government borrows within India through things like bonds, treasury bills, and securities, are expected to rise from 175.55 lakh crore in 2025 to 190.14 lakh crore in 2026. External debt or money borrowed from foreign institutions and governments grows from 6.18 lakh crore to 6.63 lakh crore in the same period. It's important to note that this external debt figure is recorded at historical exchange rates, meaning it's measured based on the value of the rupee when the debt was originally taken, not current rates. So if the rupee weakens, the real cost of repaying these loans increases, even if the official books show a more stable number. Now, when we include some accounting adjustments like updated exchange rates, extra budgetary resources, EBRs, and subtracting the government's cash reserves, the more realistic debt estimates become even higher, 185.11 lakh crore by March 2025 and a whopping 200.16 lakh crore by March 2026. That's the real weight of the burden we carry. But where does this debt actually come from? Let's talk internal debt. This includes loans raised in open financial markets through various bonds. It includes treasury bills, short-term instruments the government issues to state governments, commercial banks, and other investors. There are also non-negotiable, non-interest-bearing rupee securities issued to international financial institutions. Yes, money borrowed without offering a return, based on mutual understanding or policy obligations. This debt is meticulously tracked. In fact, the government has been maintaining records since the very first 5-year plan. These show how public debt has evolved over time, from the early years of independent economic planning up to the current fiscal years and projections for 2025 and 2026. But internal and external debts aren't the full picture. The government of India also carries a significant layer of other financial liabilities, the kind that rarely make it into public discourse. These include obligations under small savings schemes like PPF and NSC, provident funds for public employees, securities issued to major institutions like the Industrial Development Bank of India, IDBI, nationalized banks and oil marketing companies, dues to fertilizer companies, Food Corporation of India and more. Deposits under the Special Deposit Scheme, civil deposits, local funds, and the depreciation reserves of government-run enterprises. All of these liabilities are documented in the government's Statement of Liabilities, a detailed record that reflects the true book value of all outstanding obligations. In essence, it's India's national balance sheet. And what about the guarantees, the promises the government has made to back loans taken by public sector enterprises or state governments? These are also accounted for as per Rule 6 of the FRBM Fiscal Responsibility and Budget Management Rules of 2004 in a separate statement on guarantees. But debt alone doesn't tell the full story. The government also keeps an asset register showing what it has built with all this borrowed money. Think of this as the other side of the balance sheet, the tangible returns of spending. Roads, railways, defense infrastructure, power projects, IT systems, government buildings, and more. These assets are shown at book value, meaning what they cost at the time they were built, not what they are worth today in market terms. Importantly, this statement only includes assets owned directly by the central government. It excludes projects built by state governments or private organizations, even if funded by central grants. So what does all this mean for a common citizen? It means the country is borrowing heavily to sustain itself, and each citizen, directly or indirectly, shares that burden. It means that while infrastructure grows and GDP rises, there is a hidden cost of dependency. It reminds us that behind every loan, there is a lender. Behind every fiscal promise, there is a repayment clause. And unless managed with wisdom and accountability, a nation can be growing and eroding at the same time. Let's begin with the number 171.78 lakh crore. That's the total liabilities of the Indian central government as of March 2024. Think about it. 171 lakh crore. It's not just a mind-boggling number, it's a heavy anchor on our national economy. Now what's even more worrying is that this figure has gone up by 3.4% in just 3 months. You can see it clearly in the government's official data, which shows public debt alone at 15.49 lakh crore, of which 14.7 lakh crore is internal debt. 1. Total liabilities of the central government, March 2024. Now, how is this debt funded? Through borrowing, of course. And that's where treasury bills come in, short-term borrowing instruments the government uses to manage cash flow. In the financial year 2023-24, the government issued a massive 75 lakh crore worth of treasury bills. But here's what stands out. Even after repayments, the net issuance was 48,349 crore. That means we borrowed 48,349 crore more than what we repaid. This isn't long-term investment. It's short-term borrowing, and it comes with serious interest costs. 2. Issuance of treasury bills Q4 2023-24. And what about the interest rates? The average yield or interest cost on government securities during the year was 7.24%. That means for every 100 borrowed, we're paying over 7 annually in interest. Now let's look at the revenue side. In FY 2023-24, the government's total revenue receipts stood at 27.28 lakh crore. Historically, interest payments consume around 30-40% of these receipts. If we take a conservative estimate of 35%, that means 9.55 lakh crore went just into paying interest. Let that sink in. Nearly 1 out of every 3 earned by the government is being used not to build hospitals or schools, but to pay back lenders. What we're witnessing is a system where we borrow more to pay off previous borrowings, a cycle of circular borrowing. And who benefits from this? Banks, institutional lenders, foreign investors. Who loses? The taxpayer, the citizen, the economy. This is not just bad economics, it's a systematic silent wealth transfer, a transfer from the many to the few. And this is where things get dangerous. Now let's look at foreign investments. At first glance, there's a bit of good news. Foreign Portfolio Investment, or FPI, made a strong comeback in 2023-24, clocking in at $42.2 billion in net inflows. That's a sharp turnaround from the previous year's net outflow of $5.15 billion. But hold on, FPI is speculative money. It can leave as quickly as it enters. It's not stable. 3. Foreign investment inflows. Now here's the worrying part. Net foreign direct investment, the long-term productive kind of investment, fell off a cliff. From $27.98 billion in 2022-23, it crashed down to just $10.59 billion in 2023-24. That's a 62% drop. This wasn't due to lack of growth. India's GDP was still growing at 8.2%. It was because of repatriation and disinvestment, foreign investors pulling their money out. What does that say? That even with high growth, long-term confidence in India's financial sustainability is being questioned. On the trade side, merchandise exports declined by 3.1% to $437.1 billion, while imports also fell by 5.7% to $675.4 billion. The result? A trade deficit of $238.3 billion. Sure, forex reserves are up, sitting at $645.6 billion, but that's not the whole story. The government had to increase its external debt to 7.96 lakh crore, up by 1% from the previous quarter, to help manage this imbalance. 4. Trade and Forex overview. So let's take a step back. What does this all mean? It means we're not funding development, we're funding debt. We're not spending to build, we're spending to repay. And in this system, interest becomes a parasite, feeding on national resources, draining public funds, and empowering creditors. It's a trap, and it's not just about economics. It's about morality, justice, and the future. There's a reason Islamic finance views interest, or Riba, as not just wrong but dangerous. The Quran says in Surah Al-Baqarah verses 275 to 279, that those who consume riba will not stand except as one who is driven to madness. Because it's not just a financial practice, it's a system of exploitation. Islamic finance proposes a radically different approach. No interest, no speculation. Only asset-backed profit and loss sharing models that prioritize fairness over profit maximization. Take Sokok, for instance, Islamic bonds. Instead of earning interest, Sokok holders earn returns based on the performance of real assets like highways or ports. Everyone shares the risks and everyone shares the profits. Or look at Mudaraba and Musharacha partnership models where one party contributes capital, the other contributes effort, and profits are shared. It's a model built on transparency, ethics, and mutual benefit, not manipulation. Under Islamic finance, every rupee must be tied to something real, a product, a service, a business. No paper games, no speculative bubbles. just honest, equitable finance. And this isn't just theoretical. Countries like Malaysia, the UAE, and Saudi Arabia have implemented these systems with great success, financing infrastructure, housing, and entrepreneurship without relying on interest. India, a nation rooted in diversity, fairness, and resilience, should be bold enough to explore these options. The current system is failing, and not just economically but ethically. Interest payments are devouring public funds. Debt is growing, inequality is widening. Young people are trapped in EMIs before they turn 25, from phones to bikes to homes. This is not freedom, this is not growth. This is debt dependency. A closer look at India's economic surge, growth, or debt-driven illusion. On July 6, 2025, the Indian government proudly announced its latest economic performance through a report titled India's Economic Surge. The headline figure was striking, a 6.5% GDP growth for 2024-25, making India the fastest growing major economy in the world. This is no small achievement, especially when much of the world is grappling with economic stagnation, inflation, and geopolitical uncertainties. The statement from RBI Governor Sanjay Malhotra reinforced the optimism. In this global milieu, the Indian economy remains a key driver of global growth. Growth momentum is buoyed by strong domestic growth drivers, sound macroeconomic fundamentals, and prudent policies. But this raises a critical question. Is this growth genuinely driven by sound fundamentals and prudent policies as claimed, or is it being powered by an ever-growing mountain of debt? What the GDP report celebrates. Before questioning the structure beneath the numbers, let's acknowledge the reported achievements. 6.5% GDP growth in 2024-25, higher than China, the US, or the EU. Inflation dropped to 2.82% in May 2025, its lowest in over 6 years. Exports hit an all-time high of $824.9 billion US. Strong manufacturing and service sectors, high investor confidence, and booming capital markets. On the surface, this seems like a dream scenario, strong growth with low inflation and increasing global engagement. But every economic engine runs on some kind of fuel, and in India's case, a large portion of that fuel is debt. The debt-based growth cycle, a reality check? Here's where the discussion turns serious. As per the government's own budget documents and official statements, India's total public debt as of March 31, 2025 stood at 181.74 lakh crore. This is expected to rise further to 196.78 crore by March 2026. Now pause and think. The country is growing fast, yes, but it's also borrowing fast, not just to build infrastructure or spur investment, but to meet past interest obligations and roll over previous loans. This is what economists call a debt-based growth cycle. In simpler terms, the government borrows to spend and stimulate growth. That spending boosts GDP in the short term, but the loan needs to be repaid with interest. To meet that, the government borrows again. Rinse and repeat. So while GDP is rising, so is our debt burden. The key question becomes, is this growth sustainable without borrowing more every year? Question for RBI Governor Sanjay Malhotra. Mr. Malhotra confidently stated that India's growth is driven by strong domestic growth drivers and prudent policies. But one must ask Governor Malhotra, if our debt is growing year after year, crossing 196 lakh crore by 2026, how can this be called prudent? And if we are using future borrowings to pay today's interest, are we truly standing on strong fundamentals? Or are we simply papering over our cracks with more credit? The numbers suggest that a significant portion of our national budget goes into interest payments, one of the largest recurring expenses for the government. Every rupee used to pay interest is a rupee not invested in schools, hospitals, or infrastructure. Yet the government continues to borrow, increasing the total liabilities on the nation's balance sheet. It's time this was acknowledged publicly, rather than hidden beneath celebratory headlines. India's GDP for 2024-25 is projected to be around 331 lakh crore. With public debt around 196 lakh crore, That gives us a debt-to-GDP ratio close to 59-60%. For an emerging economy, this is not catastrophic, but it's certainly not low, especially when much of the spending is recurring rather than transformational. If GDP growth were purely organic, driven by productivity, innovation, and private sector expansion, the concern would be less. But the fact that a major share of GDP is influenced by government borrowing and spending makes this a fragile model, particularly in times of external shocks, rising interest rates, or global financial tightening. Growth with responsibility. What must be done? To be clear, borrowing in itself is not a sin. Nations borrow to build. But what matters is how the borrowed money is used. If it's going into long-term assets like roads, ports, railways, or clean energy, fine. If it's being used to plug budget gaps, pay interest, or fund populist subsidies, it creates future instability. India must move from debt-fueled growth to self-sustaining productivity-led growth. This means strengthening tax compliance and revenue generation, prioritizing spending efficiency, cutting non-productive subsidies, attracting private and foreign investment into infrastructure, not relying only on government funding, managing debt responsibly with clear repayment roadmaps. In conclusion, the surge is real, but so is the debt. The GDP numbers are strong. The inflation numbers are encouraging. The export figures are impressive. But these positives must not distract from the silent rising weight of public debt. So yes, let's celebrate India's economic surge, but let's also ask the right questions. Let's demand accountability. And let's ensure that tomorrow's taxpayers are not paying for today's headlines. Because a truly strong economy is not one that grows fast, but one that grows sustainably, transparently, and without compromising its future. As the author Zayd Haji put it so simply, borrowing is sorrowing. And when you look around today, you see exactly what he meant. We are living in a system where debt is the norm, interest is the master, and the people, well, we're just the ones footing the bill. So as we close this chapter, here's the question we must all ask. Are we willing to rethink the system? Are we ready to explore models that are fair, transparent, and rooted in real value? Or will we continue down this path, watching debt pile up, watching interest eat away our future, and watching our sovereignty quietly slip away? The choice isn't just financial. It's moral, it's spiritual, and it's urgent. Thank you for listening to this podcast, Nation on Lease. If this resonated with you, share this message. Start a conversation. Challenge the norm. Because real change begins when we stop accepting the broken systems as the only way forward. Today's episode offered more than a critique, it offered a call. The truths we unpacked are not meant to provoke despair but to awaken responsibility. If the concept of a leased nation feels unsettling, it should. Because behind every manipulated economy is a manipulated soul. But in every financial system hijacked by injustice lies the blueprint for its revival, rooted in revelation, built through ethics, and sustained by those willing to think beyond transactions. To explore further, visit my official websites zaydhaji.com and zaydalhaji.com, where thought meets action. My works across ethical finance, spiritual economics, and personal empowerment are available in both ebook and paperback format through Google Play Books, Amazon Kindle, Amazon India, and Flipkart. This was Zayed's Rules Ethical Finance for a global audience, where every episode is a step toward financial reclamation. Until we meet again, stay aware, stay anchored, and may your wealth always reflect your worship.